And if you have dared to log into your brokerage account today or check your hardware wallet, you are likely staring at a sea of red.
Yeah, it's brutal out there.
It really is. It feels less like a healthy market correction and a lot more like a crime scene at this point. We are living through a historic flush in the global markets. Bitcoin has tumbled from its all-time highs, completely shattering the critical support level at $74,000 and is currently hovering precariously near $70,000. But to view this in isolation would be a fatal mistake. We're looking at gold and silver, assets with millennia of history as safe havens, experiencing volatility that honestly defies standard logic.
It certainly is a moment that separates the tourists from the residents. But the central question we are wrestling with today, and the one that emerges directly from the source material we are analyzing, is whether this bloodletting is the final curtain call for the bull run, a true cycle top, or if we are witnessing one of the most sophisticated, albeit painful, bear traps in financial history. I'll be arguing for the latter, taking the stance of strategic nuance.
Right. And I will be arguing the case for capital protection. When I look at the raw data and the material, the macro liquidity shock, and the technical breakdown, I see a very clear, undeniable signal that the bull market is over and we are heading significantly lower.
Well, I think we have our lines drawn.
We do. So let me lay out exactly why capital preservation has to be the priority right now. The source material we are analyzing is explicit about this. They have exited all long-term positions. And frankly, this isn't a time for strategic nuance. It's a time for survival. Just look at the liquidity shock we witnessed. We saw $6 trillion, trillion with a T, exit gold, silver, and U.S. equities in a span of 60 minutes. That is roughly 2 times the entire market capitalization of the crypto market, vanishing from traditional finance in a single hour. Gold dropped 15% and silver collapsed 38% in 24 hours. These aren't speculative assets. These are the assets people flee to when things get bad. When you see a risk-off event of that magnitude where liquidity is just evaporating from the safest assets on Earth, you have to accept that the macro environment has structurally shifted. Bitcoin has lost the 100-week moving average. Historically, that is the ultimate line in the sand, and when it's crossed, we drop.
I understand why that implies a guaranteed crash to you. You're focusing on the severity of the drop, which is entirely valid. The speed of it is terrifying for a lot of people. But the source material also admits they don't have a crystal ball. We need to look at what is happening beneath the surface of that panic. Yes, 6 trillion exited, but I see this as a massive deleveraging event. It's likely driven by algorithms and margin calls in the traditional sector rather than a fundamental collapse of the asset's core value.
But the value is dropping.
In the immediate term, yes, but look at the Institute for Supply Management data, the ASM indicator. It is back above 50. It's sitting at 52.6.
For the listeners who maybe don't track the ISM daily, let's clarify that. That essentially signals economic expansion, correct?
Exactly. The ISM is the heartbeat of the industrial economy. It measures purchasing power, it measures manufacturing health. A score above 50 means growth and below 50 means contraction. If we look back at previous altcoin seasons, specifically 2017 and 2021, they kicked off with similar ISM setups where the economy was pivoting back into expansion. So my position is that we might be looking at what the source material calls Scenario 1. That's a deviation below $74,500 designed specifically to trap bears who are late to the party, which is then followed by a violent reclaim of those levels.
Specifically address this massive liquidity shock because you cannot separate crypto from the broader market plumbing right now. We have to address the elephant in the room here, which is MicroStrategy. You can talk about ISM numbers and manufacturing health all you want, but we just saw a global swing of $5.5 trillion in assets. The market is incredibly fragile, and right in the middle of this fragility, we have MicroStrategy sitting on a massive pile of Bitcoin with an average buy price of roughly $76,000.
They are underwater, yes. I won't deny that.
They are underwater by roughly $3.5 billion. With Bitcoin at $70,000, every single dollar it drops adds pressure to the entire ecosystem. The psychological weight of that on the market is immense.
If the price continues to slide, the narrative shifts overnight from, corporate treasury genius to asking if MicroStrategy is even solvent. That fear alone can trigger a cascade of selling that no ISM data can stop.
But that narrative completely ignores the actual mechanics of their debt. I don't buy that the MicroStrategy situation is a death knell at all. You have to look at their corporate structure. They have raised capital specifically to avoid being forced sellers in a drawdown like this. They utilize convertible notes and long-dated debt. They aren't trading on 100x leverage on some offshore exchange where a quick wick down liquidates their entire stack. They have a balance sheet that was purposefully designed to weather this exact type of volatility.
Designed for volatility, sure, but a structural bear market?
Even a bear market. The debt doesn't come due tomorrow. But more importantly, look at the macro stabilization that is happening right now. We finally have clarity on the Federal Reserve. Kevin Warsh is taking over as chair.
Right, a BlackRock alumnus.
Exactly. And the market loves certainty. We know who the chair is now. We know the government budget has passed, which officially ends the shutdown fears. The shutdown ended on February 3rd. Markets hate uncertainty far more than they hate bad news. And right now, the uncertainty is resolving. The volatility in gold and silver was a violent reaction to the transition, a reshuffling of capital, not necessarily a signal of a permanent global depression.
I'm just not convinced by that line of reasoning because it willfully ignores the technical damage that has already been done to Bitcoin itself. Let's talk about what the source material refers to as the war of moving averages. You cannot ignore the historical data regarding the 100-week moving average.
Technical analysis is probability, though. It's not prophecy.
But the probabilities are damning. If we look at the material, look at 2015, look at 2018, every single time Bitcoin loses the 100-week line, it doesn't just dip and recover immediately in a V-shape, it capitulates. It drops down to the 200-week moving average. It acts like financial gravity. Right now, that 200-week moving average is sitting at exactly $58,099. That is not a random number I'm pulling out of thin air. That is a statistical magnet on the chart. We are sitting at $70,000 today. It is a very long way down, and the historical chart structure says we are going there.
It is a compelling argument. I will give you that. But have you considered the element of time in that history? You cite the previous cycles, but history is highly nuanced. During the COVID crash in 2020, the dip below that 100-week average lasted only 35 days. It was a flash event, a liquidity vacuum. In other cycles, sure, it took 300 days or more. But we are only a few days into this current break. Furthermore, and the source material emphasizes this, we are currently sitting inside a massive fair value gap on the 12-month chart.
Why don't you define that for the audience? Because fair value gap is a term that gets thrown around a lot in trading circles, and it's crucial here.
Of course. Simply put, a fair value gap is a price range where the market moved so quickly in one direction that it left a lot of orders unfilled. Think of it like an air pocket in a pipe. The market naturally often returns to these areas to fill them and find equilibrium or balance. Right now, we have a massive gap between $44,000 and $74,000. That entire zone acts as a huge support structure. Just because we wicked below the top of that range at 74K doesn't mean we are instantly crashing through the bottom of it. We are technically still inside a support structure that took an entire year to build. To declare the bull run dead while we are still inside the previous year's value area is, well, it's premature.
I would frame it differently based on the exact same data. We aren't just resting inside support, we are actively failing to find buyers. Look at the ETF flows mentioned in the analysis. This was the primary engine of the last massive leg up, was it not?
It was a major driver, yes, absolutely.
Well, the engine is completely stalled. We are seeing no consistent inflows exceeding $500 million anymore. In fact, outflows are resuming. Institutional investors are inherently risk-averse. If the institutional bid from the ETFs is drawing up, and the retail investor is terrified because they just watched gold crash 15% in a single day, who exactly is buying Bitcoin at $70,000 to save your 12-month support level?
The smart money is buying. And this brings me back to the midterm election year phenomenon detailed in the material. The source notes that U.S. midterms often coincide with choppy, highly bearish market conditions. That's true. However, there is a crucial divergence this time around. Usually, when we hit the midterms, the ISM, that economic activity gauge we discussed earlier, is declining. This time, as I mentioned, the ISM is rising.
It is a massive positive divergence that hasn't existed in previous midterm cycles.
But is that single divergence enough? Look at all the other macro indicators required to sustain a true bull run. Is the dollar index below 96? No, it's strengthening. Has gold confirmed a cycle top? We don't know for sure yet, but the extreme volatility suggests deep instability. Did the Russell 2000 break out? No. The material shows it was a fake out, and it reintegrated right back into its range. The environment is objectively risk-off. You are putting a lot of weight on a specific divergence in the ISM to save a macro chart that is essentially screaming at us to sell.
I am looking at the potential for an accumulation opportunity that only comes around once every 3 or 4 years. The source material points out that returns after reclaiming the 100-week moving average can be absolutely staggering. We're talking plus 4,900% in one cycle, plus 900% in another. If this is indeed a bear trap, the upside is incredibly asymmetric. We are testing the 0.5 Fibonacci level right now.
And for those listening, the 0.5 Fib is essentially the halfway retracement of the entire macro move up. It's a major psychological line in the sand for traders.
Correct. If this level holds, this is the bottom of the cycle.
And if it doesn't hold, let's talk about the worst case scenario, because as an investor, you have to look at the downside risk. If we lose the 0.5 Fibonacci level, and we slice right through that $58,000 target I mentioned, where exactly do we go?
I suspect you're looking at the 6-month fair value gap lower down.
I am. The next major structural support isn't until $44,500 down to $49,500. That aligns with a roughly 60% drop from the all-time highs. That is a standard run-of-the-mill bear market correction for crypto. It completely validates the source's decision to sell everything right now. Why risk writing a position down 60% on the blind hope that this time is different?
Because selling everything right now means you are selling into a 12-month support block. It means you are capitulating exactly when the institutional smart money might be stepping in to accumulate. The source mentions the smart leg down that occurred in January 2026. Yes, it looks heavily bearish on the surface, but extreme volatility often marks local cycle bottoms. If you panic sell your spot positions because silver dropped 38% in traditional markets, you are reacting to the past, not positioning yourself for the future.
I see why you think that. I really do. But let me give you a reality check on that smart leg from the material. The January 2026 monthly candle created a massive bearish imbalance. We saw a clear rejection and an immediate continuation downwards. The weekly close below the 0.382 Fibonacci level, which was around $83,600, that validated the entry into a bear market. We are now hanging by a literal thread at the 0.5 level. If we close this week below that, the path to $58,000 isn't just a possibility, it becomes the primary, highly probable roadmap.
I agree that the weekly close is going to be critical. We are at a pivot point, but let's look at the market psychology here. Everyone on social media, every retail analyst is expecting $58,000 now. It has become the obvious target. And when the entire market leans heavily one way, especially with positive underlying economic data like the ISM bubbling up, the market has a funny way of punishing the consensus.
But betting against the dominant trend just because everyone expects it is exactly how trading accounts get blown up. The trend is down. The momentum is clearly down. The traditional market liquidity is gone.
And yet, despite all that, we are still above the 200-week moving average. We are still resting inside the macro fair value gap. Complexity often requires multiple perspectives to fully appreciate what's happening. You see a collapsing building, I see a necessary stress test that is aggressively clearing out the over-leveraged players so the market can build a foundation to go higher.
Well, let's bring this to a conclusion because we could debate the intricacies of these moving averages all day. My position remains firmly unchanged based on the text. The trend is your friend until it bends. And right now, it hasn't just bent, it has completely snapped. The combination of the flash crash in precious metals, the stalled institutional ETF flows, and the loss of the 100-week moving average tells me that capital preservation is the only logical strategy. We are highly likely heading to $58,000 and potentially much lower to that $44,000 region. The smart leg down in January confirmed this trajectory. Why fight the gravity?
Because gravity can be defied if the underlying engine, the broader economy, is revving back up. Look, I admit the technicals look grim right now. The drop to $58,000 is a very real plausibility that investors need to be prepared for. However, the rising ISM data and the newly settled political landscape with Chairman Warsh and the budget resolution suggest that the U.S. economy is actually expanding. And eventually, that macro expansion lifts all boats, including crypto. Selling now feels like a panic response. I view this current price action as a generational accumulation zone for professionals. If we can just reclaim $74,500, the entire bear case is invalidated, and those who sold will be left severely behind.
We can definitely agree on the key levels at least. The coming weeks are going to be completely decisive for the next few years. We are actively watching the weekly close relative to $74,500 to see if your bear trap theory actually holds water.
Right. And we're equally watching the loss of the 0.5 Fibonacci level to see if your market reset down to $58,000 is firmly confirmed.
It is undeniably a dangerous time to be in the market. Whether you align with being a protector of capital like me or an accumulator like my colleague here, make sure your decisions are based on the data we discussed today and not just the raw emotion of the crash.
I couldn't agree more. Intellectual disagreement sharpens our understanding of these markets. Good luck out there.
Thanks for joining us.